Two AIs, 20 years, one shocking result. One grew $10,000 into roughly $60,000. The other barely moved the needle. The difference? Not magic, hidden costs and time. We ran a 2004-2024 experiment. Crazy Trader AI versus Wise Lazy AI, same starting capital, same time frame, but very different rules and outcomes. By 2024, the gap was staggering. One AI returned about plus 150%, the other plus 500%. Why such a huge gap? In this video, we break it down step by step, setup, analysis, human lessons, and the simple truth about compounding. Let's start with the experiment. Short-term wins, long-term costs. We'll show both. Watch until the end for practical takeaways. High-frequency trading AI versus buy and hold AI, a 20-year test. Now here's how we set it up. First, let's meet our contenders. In the left corner, we have Crazy Trader AI. Think of it as the embodiment of hyperactive, high-frequency trading. Its core philosophy is that the market is a sea of fleeting opportunities, and you have to be incredibly fast to catch them. It operates on a set of complex, high-frequency rules designed to react to the market's every twitch. It scans order flow, analyzes micro-price movements, and tries to get ahead of the pack by milliseconds. This results in a dizzying number of trades, hundreds in a single day. Each trade aims to capture just a tiny sliver of profit, a few cents here and there. It's a strategy of 1,000 tiny paper cuts, constantly entering and exiting positions, hoping the small wins accumulate. And in the right corner, its polar opposite, Wise Lazy AI. This AI represents a completely different school of thought. It embodies the classic buy and hold strategy, built on patience and a long-term perspective. Its user interface is calm, displaying slow-moving charts and fundamental data, not frantic price tickers. Its strategy is based on a simple belief: true wealth is built over decades, not seconds. Now, to make this a fair fight, we established a strict set of rules, leveling the playing field to ensure the only thing we're testing is the strategy itself. Both AIs started with the same advantages and constraints. They used pre-vetted, back-tested signals appropriate for their strategy and were governed by identical, robust risk controls. We handed each AI a starting capital of $10,000, a significant but relatable sum for a serious retail investor. We then set the clock back to the beginning of 2004. Their challenge? To navigate 20 years of market history, a period that included the pre-crisis boom, the gut-wrenching 2008 great financial crisis, the long bull run that followed, the sharp COVID crash, and the recent era of high inflation. They would have to survive it all. Both AIs were restricted to trading the same universe of highly liquid broad market equities and ETFs. Think the S&P 500 and NASDAQ 100, no obscure penny stocks. Most importantly, we programmed in a realistic model of trading costs. This isn't a fantasy simulation. Every trade incurred a commission, every order faced potential slippage, the difference between the price you want and the price you get. And every transaction had to cross the bid-ask spread. For an active trader, these tiny costs become a torrent. Strict risk controls were also enforced on both. Firm position limits to prevent over-concentration, and a maximum drawdown cap as a safety net. The key difference was activity. Wise Lazy might rebalance its portfolio just once a year. Crazy Trader rebalanced constantly. This also has huge tax implications. Crazy Trader's profits are short-term gains, taxed at a high rate. Wise Lazy's are long-term gains, taxed far more favorably. This is a critical real-world disadvantage for hyperactivity, so the stage is set. One AI thinks in seconds, living in the chaos. The other thinks in decades, riding the tide of economic growth. It's a pure test of two opposing philosophies. With all parameters equal, which approach would triumph over 2 decades of market turmoil? The results were staggering. So, after 20 years, what were the results? Here are the equity curves. Crazy Trader in red, Wise Lazy in green. For a few years, they were close, with Crazy Trader even inching ahead at times. But over the long haul, a very different story unfolded. At the end of the 20-year period, the difference was staggering. Roughly plus 150% for the frequent trader versus a massive plus 500% for the buy and hold strategy. In dollar terms, the initial $10,000 in the Wise Lazy portfolio grew to about $60,000. The Crazy Trader's same $10,000 grew to just $25,000. So why this enormous performance gap? The primary culprit is the hidden killer: trading costs. Most investors focus on gross returns, but your net return is what truly matters. For Crazy Trader, a legion of small costs mounted into an insurmountable obstacle. On paper, before costs, Crazy Trader's strategy generated gross alpha. But this was an illusion. Once we subtract the real-world costs, the net returns, the money that actually stays in the account, were significantly lower. Let's break these costs down. First, commissions. Second, the bid-ask spread, a tiny toll you pay on every single trade. For a frequent trader, this happens hundreds of times. Finally, there's slippage, the difference between the price you expected and the price you got. Each is a small leak in the boat. With high turnover, these small leaks become a flood. Crazy Traders' constant activity meant they were paying these tolls over and over, shrinking the capital base available for future growth. The second major drain was taxes. Gains on assets held less than a year are taxed at your higher ordinary income rate. Crazy Trader was constantly realizing short-term gains, getting hit with the highest tax rate. Wise lazy by holding deferred taxes and qualified for the much lower long-term rate. This tax drag is a powerful headwind. Now for the superpower Wise lazy had, compounding. Think of your portfolio as a tree. Wise lazy planted their seed and let it grow undisturbed. Crazy Trader, on the other hand, was constantly trimming the branches with every trading cost and tax payment. The tree was perpetually stunted. When returns compound, gains generate more gains exponentially. A small difference in the net annual return might seem insignificant in 1 year, but when compounded over decades, the gap between the two outcomes becomes a chasm. After all costs and taxes, Wise lazy achieved a higher net compound annual growth rate, or CAGR. Crazy Trader's higher volatility and constant drag resulted in a much lower CAGR. Over 20 years, the power of that higher compounded return multiplied Wise lazy's small annual edge into a massive final advantage. Compounding, the eighth wonder of the world. We even ran sensitivity tests, simulating a zero-commission environment. While lower costs helped, it wasn't enough. The drag from the bid-ask spread, slippage, and especially taxes remained. For Crazy Trader to win, their combined costs would have needed to be near zero, an impossibility in the real world. There's another critical factor: market crashes. A frequent trader is more likely to panic and sell near the bottom, turning a paper loss into a real one. They miss the recovery. Wise lazy, by holding on, endures the drawdown but remains fully invested to capture the powerful rebound. This is where compounding earns its keep. So, Wise lazy had higher returns. But was it riskier? We measured KGR, max drawdown, and the Sharpe ratio, which is return per unit of risk. On every metric, Wise lazy came out ahead. On the risk-return plane, it sits in the ideal spot. Higher returns for lower risk. Crazy Trader was the worst of both worlds. So to summarize, the underperformance wasn't due to a lack of effort. It was a direct result of the relentless friction from trading costs, the punishing drag from taxes, and the failure to harness uninterrupted compounding. But these numbers only tell us the what, not the why. Why do so many investors fall into the Crazy Trader trap? The answer lies not in spreadsheets, but in the complexities of human psychology. And that's exactly where we're headed next. At our core, we are emotional creatures. We feel the pull of greed when markets are soaring and the sharp sting of fear when they tumble. And make no mistake, algorithms and trading bots don't erase these fundamental human emotions. A tool like Crazy Trader might execute the trades, but you are the one who decides when to turn it on, how much capital to risk, and when to pull the plug. The real battle isn't fought on the charts. It's fought in your own mind. Crazy Trader can generate a rapid series of small wins, and that feeling can be intensely addictive. The screen flashes green, a quick gain appears, it feels good, it feels easy. This is the siren song of high-frequency strategies. Each win delivers a dopamine rush, creating a powerful feedback loop that makes you want to trade again and again, chasing that next high. It's a design that mirrors the intermittent reinforcement of a slot machine. But those quick, thrilling wins rarely translate into long-term wealth. Why? Because you're trying to fill a bucket with a leaky hose. Every single trade incurs a small cost, a fee, a spread, a potential tax event. These tiny leaks, repeated hundreds of times, drain your capital. More importantly, by constantly taking small profits, you never give your investments the time and space they need for the magic of compounding to take root. In stark contrast, Wise Lazy operates on a completely different philosophy. It understands that in investing, your biggest enemy is often yourself. By encouraging patience and reducing decision friction, it conserves your most valuable resource, your emotional energy. This isn't about being lazy, it's about being efficient, setting up a system that protects you from your own worst impulses. This brings us to the classic behavioral traps that snare so many investors. First, overtrading, the mistaken belief that more activity equals more profit when it often just leads to more costs. Second, hero trading, trying to make one massive life-changing bet fueled by ego. And third, chasing past performance, piling into an asset it has already had a huge run-up, buying at the peak out of fear of missing out. The distinction is crucial. Short-term trading often feels like a casino where the odds are subtly stacked against you. You might have a winning night, but the house always wins. Long-term investing is like planting an orchard. It requires patience, but over time you build a productive asset that generates value year after year. You're building scale. And what does scale do? It unlocks the eighth wonder of the world, compounding. When you reinvest your gains, they become part of the new, larger base that generates future returns. Over decades, this effect is exponential. So if you still choose the active trading path, you must be ruthless in managing its hidden drags, especially costs and taxes. Every time you sell for a profit in under a year, you create a short-term capital gains event, taxed at a much higher rate. Let's distill this into 3 practical takeaways. 1. Track your fees relentlessly. 2. Let your winners run. This is the hardest rule, but it's where real wealth is built. 3. Rebalance, but do it rarely, perhaps once a year. The best way to implement this is to automate where possible. Set up automatic weekly or monthly contributions. This is the core of the Wise Lazy philosophy. It makes your investment plan a system, not a series of emotional daily decisions. Thankfully, the tools for this have never been better. Low-cost brokers and broad market ETFs are powerful allies, giving you instant diversification and capturing the growth of the entire economy for a tiny fee. It's crucial to remember, in investing, activity is not the same as productivity. Don't confuse motion with progress. True productivity is setting up a sound plan and having the discipline to let it work. Think generationally. The slow, steady drip of small, regular contributions will build a far larger reservoir of wealth than sporadic hero trades. These regular contributions are the fuel that turbocharges the compounding engine. And beyond the financial returns is a profound, underrated benefit. The peace of mind that comes from a patient plan. You get your time and your life back, so what should you do next? Summary 1. Trading costs matter. 2. Time is your ally. 3. Compounding wins. We showed how the buy and hold AI outperformed over 2 decades. Now tell us, which AI strategy should we test next? Leverage, gold, or crypto? Practical steps, audit fees, automate contributions, and favor diversification. If you want, set a simple rebalancing rule, quarterly or yearly. Test small experiments, but measure after costs and over time. If you found this useful, like, subscribe, and hit the bell for more experiments. Comment below which strategy we should test next. Leverage, gold, or crypto. Thanks for watching. Invest patiently and let time work for you. Resources and methodology are linked in the description. This video is educational, not financial advice. See you next time.